Happy week 132. I don't know if it's so happy after that rate announcement we had last week. September the 7th was that big day that we were waiting for. And unfortunately, unfortunately in the sense that it happened, but it certainly wasn't a surprise. If you watch the video that I uploaded on the 7th, the day after the previous market report, you would have seen all the information on this. You can check it out if you didn't watch it, but there was that 0.75% increase and a message saying that there will be continuing the quantitative tightening process to help mitigate a lot of this inflation issue that we have right now, which is really beyond our control, to be honest. I mean, you could do what you can to quash demand by making it harder to get access to money. But at the same time, gas prices have come down, which has brought inflation back a little bit. But there are so many other influences happening globally that are going to prolong this inflation issue, which has given me more of a bleak outlook for the rest of this year in terms of Toronto real estate anyway. I mean, we all know that Toronto real estate is a very strong asset. Owning any sort of Toronto real estate, especially in the urban communities surrounding the downtown core, you're going to do well long term. But right now we have a bit of a storm to weather as we head into the rest of the year. We know that there are going to be two more increases this year, one more coming up in October and another one after that in November. Some experts that we're talking to are saying that the next increases will be a little more moderate, 25 basis points each for a total of another half percent increase or 50 basis point increase before the end of this year. I'm not going to speculate on whether that's actually going to happen or not. To me, it would be foolish to have another situation where we have a mega 0.75% or more increase at one time. I think that would be a bit triggering for the economy. I don't know if that's something that would be a very smart move if we want to delicately thread that needle between quantitative easing and tightening. But I do feel that we have a 18 to 24 month period of fairly stagnant growth, if any at all. So the next couple of years, you should be very cautious with how you're spending your money. You should definitely be looking at buying opportunities in the real estate market. That does not mean you shouldn't be doing that if you can handle the expense. That's one of the big opportunities that I talked about on the blog this week. Is there are properties that were trading as where are we here? We had properties that were trading, up to 1.25 that are trading in the 900s, so there are some great opportunities for you to purchase those homes for cheaper today. But it's really important to also understand that those homes that were purchased back in February for those big numbers, you're getting a discount on those homes today, but it's costing you basically the same to carry that property today. The big benefit there is that the property is not, the property has become more accessible because of the closing costs have come down. Land transfer tax would be cheaper. And also, a lot of buyers simply were not approved for properties over $1 million. But now, those people that had those 999 approvals with less than 20% down can now access these homes they previously did not have access to. So despite the fact that the carrying costs of these properties are the same, if not more in some cases, ignoring it, despite the fact that the cost of the home is much cheaper, the big opportunity there is they've been made more accessible, not because they're cheaper to carry, they've been made more accessible because it requires less capital to acquire the asset in this scenario. So, and again, any buyer right now that is making purchases is going to be doing fantastic 2 years from now when we have another run up, because as we've seen, we don't have that pylon of listings going right now. And looking at that specifically, this is the first time in 8 weeks where we actually have new listings on the market. Sorry, not new listings, an increase in the amount of listings on the market. This has been coming down from 625 listings over the past 8 weeks down to 414 last week. And we've added over 50 listings week over week, which is quite a bit, but not as much as we thought would come right after the summer months were done. Right when the fall market comes, usually we have a listing flood of way more than this. But what is concerning to me are these 34 sales. This 34 sales figure, like to only have 34 houses sell in what's traditionally a very busy market, is a serious red flag for me of what's to come. I feel like these 34 sales are representative of a really slow summer, end of summer, dog days of summer kind of market over like the Christmas week, but not for the first couple of weeks of fall. So this is very interesting for me because if we continue to have listings come on and sales stay this low, there's going to be a really, I don't want to be too dramatic about it, but there's going to be an effect in the market that if you are a seller that absolutely has to sell, you're probably going to feel that over the next few months as interest rates are not yet ready to come back down. So keeping an eye on sales figures is really important for me as well as listing supply. So fingers crossed that we have a lot of sellers that decide to pull their properties off the market because that is going to be the real issue down the road. But right now we also have a pylon of condo listings. Condo listings have pulled back from nearly 2,000 condo listings all the way back to 1,400 and change last week, have added almost 100 new condo listings week over week. And with sales at 67, where we're normally at 200 to 220, that is also a concern. So if you're in the market right now to make a purchase, you do have a little bit more leverage than you did even a couple of weeks ago. So take advantage, make sure you're working with a local pro that can help you appropriately leverage and get the best deal available out there. But there are still some properties that are going into massive multiple offer situations. So, what areas are going into multiple offers? And that's a really good question. And as we've talked about before, we've had neighborhoods like North Riverdale. As long as you're in the Jackman or the Withrow and those school districts, your value tends to be protected really, really well. Another neighborhood that's outperformed the markets as a whole, a neighborhood like Roncesvalles, which has seen very little turnover of new listings. And whenever a new listing comes up in Ronci, especially if it has parking, it is flying off the shelf still. So there are, make no mistake, multiple offers are still a thing. But in general, especially if the property has an income producing component to it, like a basement apartment, those are still doing very, very well. Of course, taking advantage of the incredible rental market as it is today. But, the majority of Toronto's communities are going to slow down tremendously over the next couple of months. And again, slow down tremendously does not mean a massive price adjustment, which could also come with it in some property types, but not in all property types. And in the past, I have been guilty of saying, let's say in January or February, these high prices are usually set, and then the following sales usually support that high price. And when the market slows down, we have fewer options. So we have those people kind of supporting those prices, and listing strategies are changing. But what really is happening right now is, because of the massive interest rate increases, is we are having a price adjustment on a lot of those properties, not as much as a lot of people led you to believe. So a 30 to 40% increase in interest rates over time does not equal a 30 to 40% drop in prices over time. So they're not directly connected like that. But what we have seen in our urban markets is, anywhere from like a 5 to 20% adjustment in some cases, with some not adjusting at all. So it's very, very important that you don't paint the entire market with the same brush and say, all properties are down 20%, all properties are down 30%, when that is just not, not the scenario. Again, long term, the prices people paid in January and February will be just fine, but the next 18 to 24 months, there's going to be a little bit of a time before that curves back up to make people whole again in that scenario. So looking back at the blog, you can see that sales are still happening and months of inventory is still down. We'll run those numbers at the end of the month and see where we land there. And like I said, those entry-level homes are now way more accessible for a lot of people. And if we didn't have any of this buyer sentiment issues, in terms of the months of inventory numbers, we are in a strong seller's market territory, as if you look at the numbers. But we have, of course, many buyers are either out of the market or continuing to take that wait and see path. And that wait and see path is what it is. I mean, if that's what you want to do, that's what you want to do. If you're somebody who didn't get caught up in the FOMO of 2022, early 2022, like, kudos to you. That's impressive. Like, everybody was buying at that time because they felt like it was their last chance to get into the market. If you said to yourself at that time, I'm going to wait this out and see what happens, prices are high, and you wanted nothing to do with those high prices. But there's a flaw in your thinking at that time. Like prices don't just come down because they're too high. There would have to be something to trigger the prices to come down. And you're not going to be isolated from that economic event. So in reality, you're going to be affected by these economic events. So you're not going to buy that house for $800,000 that used to be $1.1 million and pay that same amount for it. So a lot of people were ignoring the realities of how the market would look and how the economy would look in a time when things are down. So like I said here, you're still paying the same to carry the place, but now they're more accessible. Require lower down payments and closing costs may be reduced. So that's all really a good thing. So if you're still sitting on the fence, what does the bottom of the market look like to you? And that's a question that I ask a lot of people who are just waiting and waiting and waiting. But at the same time, it feeds into that whole day trader mentality where we're not day trading real estate here. We're talking about homes that are more lifestyle decisions than anything else. And you'll have a lot of people out there argue that a home should not be an investment. Well, it just happens to be a really great investment, especially if you have a long-term outlook. And there's always going to be demand for homes in Toronto and Toronto's urban communities. And like that is without a doubt. Like it's very hard for you to present me a valid argument telling me that homes in Toronto won't be desirable down the road. You can say, oh, but my kids won't have that same experience and they won't be able to afford to live in Toronto. They just won't be able to afford to live in Toronto the way you started out in Toronto. Every generation is going to have a different origin story in Toronto. They're going to have a different real estate ladder story in Toronto. My parents were able to buy a house when they squirreled away enough money after immigrating here in 1976. They bought a house in the early 90s for $208,000 at Don Mills and Shepherd. That same house is $1 million today. I get that, my daughter won't have that same experience. I didn't have that same experience. My first house was a 400 square foot condo at Bayview and Shepherd that I bought for $167,000. You can't do that today. But money is a lot less expensive today. So you can buy that $400,000 condo and have that same kind of experience. You're just going to start somewhere else. Or you're going to remain a renter. And there's nothing wrong with remaining a renter here in Toronto and taking that money and buying in a less expensive market somewhere else. That's how I really worked my way back into real estate after selling my house and making some bad investments. I got back to where I am today with my $2.5 million house, cars, whatever it is that I have. I got there by renting a place in Toronto and buying a $200,000 fixer-upper in Perry Sound that I was able to leverage Airbnb, fix, and a year later I was able to flip that into a 3-bedroom condo downtown, which I was able to flip into the house that we have today. So I think that today's market and the market going forward requires a lot of out-of-the-box thinking, that you are not going to have the same experience that your parents did or your grandparents did here in Toronto, but you can still have a very successful real estate experience if you adjust your expectations and adjust your strategy a little bit, which is what a lot of people don't seem to understand and somehow feel entitled to have access to detached houses for the same price their parents did. I will never feel sad about the fact that my daughter won't be able to start the way I did. Luckily, I'm able to provide my daughter with the resources to be able to start a little further ahead than some people. I have purchased a pre-construction condo for her that I will give her when she's 18. A lot of people won't have that opportunity, but you can do with your situation what you can. I just don't have time for feeling sad for people about a situation I can't change. So if you want your children to have a different experience than yourself, then educate them and help them understand that positive thinking, optimism, and an adjusted strategy with an open mind will help you be successful versus just whining and complaining about something you can't have. That's what children do. So sorry to be so harsh about that, but it's just triggering for me to hear people whine and complain about it when they can take that same energy and put it into helping their offspring do better, and which is what I hope to do for my family. So keeping this week's relatively short, I'm going to end it right there. If you have any questions or comments, please do that below. And if you want to see any videos about other things, I really want to hear about that too. And I kind of forgot to tell you what this video is. This is 132 weeks in a row of reporting since COVID began nonstop. And you can catch all of that on the website at thespringteam.ca/blog. You can go back 132 weeks and see all the stats for yourself. So with all of that said, thank you all so much. And I will see you on the other side.